Starting a business can seem like a daunting task, unless you have a partner like Shopify. They have the tools you need to start and grow your business. From designing a website to marketing to selling and beyond, Shopify can help with everything you need. There's a reason millions of companies like Mattel, Heinz, and Allbirds continue to trust and use them. With Shopify on your side, turn your big business idea into... Sign up for your $1 per month trial at shopify.com/special offer.
Reality radio for a really great future. We're talking real money.
And now for something completely different. Occasionally fatuous financial conversation here on the Talking Real Money radio program. Hello, everyone. I'm Don McDonald, along with my cohort on the West Coast, Thomas Charles Koch II. And we're here to help you muddle through your messy money life. So, if you'd like to call us and have a little chat with us, well, we don't take ourselves too seriously. Give us a call at 855-935-TALK, 855-935-8255. Now, you should be, if we were pandering to you, if we were the kind of folks that most folks are who give financial advice on the radio, we'd be doing something like promising you, look at the market. You could make 15% per year based on what the stock market has done over the past decade. But, Tom, we don't say that.
We don't. By the way, welcome. And anytime you say fatuous,
welcome.
You do sound like you're making yourself a little more important than we actually
are.
No,
fatuous means silly.
Yeah, I know, but we're not silly. That's the whole point.
Yes, we are.
Right?
We're seriously.
Oh, I thought, okay.
We're silly. We're seriously.
We weren't silly.
No, we are. We're fatuous at times.
We try to keep it light.
We try
to keep life
it
is
light
way too serious.
Exactly.
Especially today. Wow. Yeah. So we live in interesting times, right? I mean, on the one hand, it's great because I hadn't realized that the S&P 500 had delivered 15% a year for the last decade.
I didn't either until I read that
wow.
Jason Zweig article, and I went, actually, it did make 15% per year when you look back.
Pretty doggone good, which makes people complacent, makes people feel comfy about their retirement. And his point is, and I think it's well stated, you can't count on that. That's not very close to historic, which is closer to 10.
That is not a reasonable expectation, even in your wildest dreams.
Yeah, I think it's 50% higher than the average, right?
But doesn't that mean, though, that we should expect some sort of reversion to the mean?
I would, if I was a statistician, yes, I would agree with you. But I'm not, because I don't know what the future holds. And by the way, I looked this up because I was curious after I read that number. There have been people for a very long time, including one John Bogle, who was kind of the founder of Vanguard, who's been gone 6.5 years. Yeah. Gone 6.5 years now, who've been telling you many years before his death that don't expect the market to be as good as it's been. So for a long time, people have said this will not last. So we don't know that. Okay. That's fine. But I think that what Zweig's really saying is it comes down to two other parts of your portfolio. I mean, two other parts of your finances. Part one is spending, which people have a tendency to ignore, and they feel good about their money. They're going to buy whatever they like, and saving. And his point is, and I think this is absolutely people always want to go to the cake before they eat the pudding, right?
Yeah.
The thing is, that was a bad joke too. If you're not saving anything for the future, and if you're not paying attention to your spending, it won't matter. The market will not save you. It's unlikely to save you even at 15% a year, right? That's the thing people have a tendency to ignore. And he's absolutely 110% right. If you want to have a great retirement, I just met with somebody last week who's never made more than $100,000 a year and has $4 million saved, which I think is remarkable.
That's very good.
It's very good how much he's been spending. He's been frugal. I had urged him, go spend your money and enjoy it. But until you tame that part of it, the whole investing discussion and which part of the market and all that, it doesn't matter. It really is not. It's irrelevant, if you will.
Yeah. And the point is, of all of this is that you have to set reasonable expectations. You can't get caught up in, and even 10 years. We talk about this a lot. Well, people will say, well, those value stocks, they haven't done well over the last 10 years. It's the growth stocks that have done well. I should be in the growth stocks. Or international has done badly over the past 10 years. I shouldn't be in international stocks. We believe that 10 years is still too short a period of time to really make reasonable data-driven comparisons. So you've got to quit getting caught up in the day-to-day and start thinking longer term, and that's the goal of this show, despite the fatuousness. 855-935-TALK is our phone number, 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
The show continues. I'm Don, along with Tom over there. You're out there. We have a phone number for you to use, 855-935-TALK, to have a conversation with us about your money situation, because that's what we want to default to. Now, over the past 10 years, believe it or not, the U.S. stock market has done incredibly well, returning about 15% per year. So let me help you put that in future perspective. It's a bit of a Pollyannish perspective, but think about it this way. Your investment portfolio has prepaid expected gains. So you got them early. So if you have much lower returns in the future, you shouldn't gripe, because you got them ahead of time, which gave you more time to make money on the money that you made early. So there you go. Think of it that way. You'll be fine.
I'm still going to complain. By the way, this article is also based on some relatively new research that I had not seen, where they went back to 1793 to look at how stock markets have done over a really long period of time.
That's when they gathered around the tree pretty much to start the
tulip bulbs and whatever
tree.
Else they were.
It was the buttonwood tree on Wall Street where they started the exchange.
I'm betting that Elon wouldn't have got his $1 trillion deal in 1793, but
people didn't even know what a trillion was.
That's a good point. Go back to 1793, according to Jason Zweig, according to this research, the average of all stocks has been about 6.1%, which is nowhere near 15, or that's crazy. They also looked at something I think more interesting, which is, I think, fairly relevant, 30-year periods of time. Yeah. 30 years, because that's
a good period.
And that's a lifetime in some ways for many investors, right? It could be longer, could be shorter, but 30-year periods. And what they found was 30 years, right?
Rolling 30-year periods.
There's many periods of time where stocks barely make more than inflation, make about 3% more than inflation. I kind of rolled it all together. There's 20% of the years where it makes somewhere between 6 and 7%.
Well, hold on.
Not real return.
Yeah, I was just going to say, be careful with that, because I believe that average return they're quoting, that 6.1, is after inflation.
I'm not sure about that.
Because he goes right into everything is annualized after inflation. For example, he says over the 3 decades ending December 2023, U.S. stocks returned an annualized 6.9% after inflation. I'm pretty sure that 6.1 is an after inflation number, because Zweig, he said it in the paragraph before and in 2 paragraphs after. So
Real rate of return.
I think it's real rate of return, which is after you suck out inflation. And you said it's low, but I got to tell you, even if you were making 3% more than inflation.
Right, so 6% on average.
You're still making money.
Yeah, that's true. You're staying ahead of
savings
of increased costs for whatever you've got to face. So you would have been okay. But I still like the fact that he spends considerable time talking about the two areas, again, that I don't think get the attention they deserve: spending and saving. If you don't carefully figure out how much you're going to need, right, and include emergencies or other things that come along, that's going to kill you. And if you're just saying, I'll get to spending later, I'm 30 years old now, people worry about retirement when they get to 50. You'll be worried a lot at 50 because you won't have enough. By the way, you would have missed these great years. That's the other part of saving, right? Setting it aside, letting it grow depending on what the market provides. So those are two hugely overlooked areas, I'd say.
And I think looking back is really helpful because what it says is what your expectations should reasonably be. And I believe 30-year rolling periods are a reasonable look back. I really do. And if you look at the worst case periods, and that really was the worst case realistic period. Worst case ever was the 30 years that ended May 1932, where stocks only gained 1% after inflation, a real return. Yeah. But that was an aberrant period that included, it got hit really hard right there at the end by that huge drop in the in 1929. So if you look at just the kind of the average low end, you're looking at that 3% over inflation. So if you set your current expectation for your portfolio at about 6%, the likelihood of disappointment declines dramatically.
Yeah, and I think if for purposes of planning, always plan for those lower returns. Test the worst case, always. Mm-hmm. Number two, this is a good reason to be diversified between stocks and bonds. There are people now saying, hey, the future is all about fixed income. Wasn't it just like a year ago people said to give up on it?
Get out of fixed income. Yeah, I know.
Don't want to own it. But they're very different types of securities. Maybe you want to own some of both. And then the other part of this, frankly, that you and I talk about ad nauseum is avoiding recency bias. People have a tendency to think that this will just keep going on forever. It's just good times. And you could really pay a price if you don't have your plan built for potential bad times, which could be just around the corner.
Don't live too close to the now. Look back. But there's another interesting conclusion that Zweig draws and presents in this article, which I think is really valuable, particularly for younger savers and investors. And that is, what should my savings rate be based on differing expectations? And if we said that 3% real rate of return after inflation over 30 years is probably the low end. The high end is maybe 6%. So you're looking at somewhere likely between 3 and 6%. So let's say your expectation is 4%. I'm going to get a 4% real return over the next 30 years. I'm 35 years old. I'm getting into saving and investing. How much do you need to save a year to get to where you need to be? And that number is the number that comes up a lot in talking to financial planners, and that's 15%.
I was going to say between 15 and 20. That could include, by the way, a match. Mm-hmm. You're saying, that much. That can include your match as well. So there's hopefully 3-4%. We always talk about ours. I forget what ours is.
It's really 15. If you're expecting 3 real return over 30 years, then it's 20. If you're expecting 4, then it's 15. If you're expecting 5, it's about 11.
Yeah. I think that's a good way to put it, and don't always even plan on that forever because things may change.
And it's a good simple planning exercise and tool. It just gives you, because one of the things that comes up a lot is, how do I get there? How in the world? How much do I need to put away today to get there? And this is a great rule of thumb method of determining that. Looking back at the very long past, 1793. I mean, didn't we were only 10 years out of the Revolutionary War then, weren't we?
Yeah, I don't think the economy was actually bustling at that time. So we were what we call a developing market at that time.
There were a handful of people buzzing around the buttonwood tree who
they didn't even get to this coast until the early 19th century, right? So pretty much.
Yeah, your coast? Yeah, no, your coast is still brand new. My coast, it's a little older. Destroyed. My kids live in a town that's 500 plus years old.
Wow, that's getting up there.
It's a senior citizen.
It's a good place to reside.
It's an old place.
This is all good. Yeah, I love it. And again, so you got to save. You got to know what your spend is. You got to face the reality that even the immediate future could look a whole lot different than the immediate past. I'll put it that way.
And don't expect. Let's say you've been lucky enough to have been heavily invested in the U.S. over the last 10 years. Good for you. Congratulations. You weren't smart. You were lucky. Now spread the risk around a little more because the future is unlikely to look as bright. 855-935-TALK is our phone number. Call us now.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And remember, this is the only time that you can call and have a conversation with the two of us. These 2 hours we spend on the radio in Seattle. The phone number is 855-935-TALK, 855-935-8255. If you're listening to the podcast, those 2 hours happen on Saturday from noon to 2 Pacific, 3 to 5 Eastern. So call us then. Now. Then or now. I can't tell whether I'm here or on tape. I don't know.
Well, or in the past. I mean, because somebody did just write me and said, "Who is Pollyanna? Was she a coworker of Don's in the 1700s?" I guess that was a.
Did somebody actually write that, or did you just do that?
That's right.
Seriously, do they?
I'm not that smart. Right there.
Pollyannish refers to overly optimistic.
Yeah, I'm aware of that. We'll also like to shout out, before we get to questions, to Jeff in beautiful Canada, who sent us a lovely picture of him and his brother wearing their new Talking Real Money shirts. That's in your inbox. You got to check your email from time to time.
Did you send me email?
I didn't. He did. Thank you, Jeff, for listening.
Jeff sent it to me.
He's wearing the shirts. There's a beautiful picture. There's a nice looking lake behind them somewhere in the central part, I believe, of Canada. And he just sent that this morning. So, and Don checks his email about once every decade.
I don't check it very often.
Portfolio.
I don't find Jeff. I'll keep looking.
It's there.
All right.
Pretty sure it said.
I know what the problem is. He probably sent it to my Appella email.
Probably.
And I hate my Appella email because I always have to go log in. Oh, that's very nice. I always have to re-log in and go to that stupid Microsoft Authenticator thing, which I just despise.
I know.
It's like, you've been off email for 2 days. You need to re-authenticate. And if I don't have my phone with me, I can't re-authenticate. Oh, I'm sorry. I'm venting again, aren't I?
Yes, you are.
All right. There's another way we take questions, too. This one's a little different. You go to talkingrealmoney.com. You click the Contact Us button up in the upper right corner, and then you type a message to Tom, or you speak it to me for the Saturday or the Friday show. I'm losing my mind. And Tom happens to have one of those typed questions in his grubby little paws right now.
I do indeed. From Vinton, Virginia, Ron writes us. Don and Tom, I turned 72 in 2025 and will have to take my RMDs next year. That's correct. My IRA is at Vanguard, and I know they can handle the RMDs, but not much information out there about how to do it. I have 8 exchange-traded funds in my individual retirement account. Do they take the same percentage out of each ETF, or do they take out the winners and not the losers, or they do it as you instruct them to rebalance your account? If you have some non-Vanguard ETFs, does that change anything?
Yeah, you tell them what to do.
Yeah, well, it depends. If they're managing the money for you, then
if they're managing the money, then then they should take it for our clients. They should take it from what they would typically do. And I can't speak for Vanguard, but what they would typically do is use this as a rebalancing opportunity. So, for example, they would say, "Oh, look, the stock portion of the portfolio is way up. So, rather than selling the stocks and buying the bonds, we're going to sell the stocks and put that money toward the RMD."
That's exactly right. And that's what you should do if you're doing it on your own. You would simply, at the time you're going to make that distribution, you would rebalance the portfolio. Say, I was in a 60-40. It's now 65% in stocks, 35% in fixed income. I'm going to sell off those stocks. I'm going to use that cash to pay the RMD, et cetera. And by the way, A bit lost because they don't get the attention that, well, only when they're doing poorly. But bonds or fixed income, pretty good year. I just looked at the dimensional intermediate term government bond fund is now up 6.2% year to date. I didn't look at the BND. I didn't have time to go that far. But, fixed income is feeling pretty good about the potential for interest rate cuts here very, very soon.
Yeah, let's not get that in people's heads, though.
Oh, it's guaranteed.
And by the way, I wanted to add to the rebalancing thing. So to the RMD, if your 5%, that bit that you trim off of whatever part of your portfolio is overweighted, doesn't meet it, then you'd withdraw evenly to maintain the balance across the portfolio. You take the rest equally out of whatever funds are in there. And when you have as many funds as you have, you're going to hope they're doing it because it's going to be a pain for you.
It is. By the way, the BND is up just a shade under 6% year to date.
But nobody wanted to be in bonds.
Oh, bonds suck. You don't want to own those. They don't ever make money. Well, kind of. So anyway.
This is the thing. Quit playing the short-term, recency-biased game that we cannot help playing as dumb humans. And again, it comes back to the point we made earlier.
Dumb humans. We're not supposed to use dumb. That's the Ramsey thing. He gets press.
I am not, by the way, I'm not directing that at any specific individual.
Not a person. This is dumb as in the royal dumb.
This is dumb as in all of us have a high degree of dumbness, and if we don't recognize it, then we're dumber than most. So, I mean, come on. It's human. I mean, every day I look at the dogs and I go, now they are easy to deal with.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Welcome back to the program. Don McDonald here. I know that was a longer break than we usually have. That's okay. We'll have a shorter one later. It's like
I thought we'd been canceled or something.
just like the returns on the stock market.
That's true.
Preloaded this break so you can have a smaller one in the future. 855-935-TALK is our phone number for your questions. 855-935-8255. Now, Tom and I are really excited. Our wives probably not as much. My wife, she went, oh, no, it's not, is it? No, don't tell me. No, it's not football season, is it? I said, yeah, because every Sunday we've been going to a movie. She goes, well, what's the movie this Sunday? I went, oh.
The Denver Broncos?
I said, yeah, movie? This week, that NFL Sunday ticket thing I got. You remember? She goes, oh, no, it's not football season. So anyway, it's football season. And Tom and I are both really excited because the Chiefs lost.
Well, and the Raiders haven't lost yet. So
I mean, this is the best day of the whole season for him. It's their only unbeaten record for the year.
I think that's probably right. No, they're picked fourth in the division.
Fourth in the division of four. Not bad.
Oh, damn. I forgot. That's a bad news. Well, I was all excited. I saw fourth. That sounds good. But no, there's only four
But Tom
teams.
is actually taking some minor solace from his team's likely terrible performance. Well, it's the only solace he can take.
It's limited. Yes.
Limited solace. I guess that when they moved to Vegas, they increased their value?
Well, they have a brand new, beautiful stadium.
Do they own that? Must own it.
That's a good question to which I don't know the answer. But for whatever reason, Las Vegas, good market, et cetera, a better place to be than, no offense to my hometown and city of my birth, Oakland. So,
do you have any teams left there?
I think the Warriors moved across the way.
Yeah,
too, right?
and the A's.
They're in Sacramento for the moment.
So
that's a good point. Well, and I left too. So we all left.
Is there anybody left to turn the lights off?
I guess not. I'm not going to feel bad about Oakland. But so this is about valuations of teams. I find this fascinating, actually. But it wasn't that hard, and I think you did, to predict the highest value. So if your team sucks on the field, then maybe off the field it looks better, right? The money looks good.
Yeah.
But the team with the highest value is not hard to pick. You nailed it. I think it's fairly intuitive. Well, because they are, quote unquote, America's team, right?
Yeah, it's going to be something that's very, very extraordinarily. It's either the largest city or the highest degree of popularity. And the highest degree of popularity you have to assign to America's team, the Dallas Cowboys.
Even though I think someone just pointed out recently they haven't won a playoff game since Bill Clinton roamed the halls of 1600 Pennsylvania. So it's been a while. But
Wait, I thought we had more time.
Let's keep going. This is all breaks all the time, so stand by for that.
This was the world. We just had the world's longest break, and now we have a 2-minute show? We'll be back.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
All right, Tom, talk very quickly. We don't have a lot of time. We don't have as much time as we usually have, so you have to talk really fast.
I'm back on public television where we used to, take time out from our pledge drive to do the program.
That's right. I love the pledge drive. These days, they need more of those pledge drives because their budgets are cut.
Sure. Yeah. Right. Sorry. It's not us. We're just putting it out there.
We're just the messengers.
Yeah, we're just delivering.
We're
talking about
vehicle.
Team valuations of the National Football League teams.
Like anybody cares. Yeah.
Well, I think it's kind of interesting.
Okay.
Dallas, we mentioned, is the most valuable, not on the field, but off the field team at $12.5 billion evaluation.
Wow, that's a lot of money
Jerry
for
Jones.
a game.
Not doing well picking players, but wow, you're doing something right in the back office there. L.A. Rams, I would not have expected.
I would. Market. It's a big market.
SoFi new stadium, blah, 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 $10.7 billion. New York Giants.
A big market.
I think their losing streak is longer than the aforementioned Cowboys, $10.5 billion. Then, not number one on the field, but not even close, but your Las Vegas football Raiders at $9.3 billion with a B. Now, here's the interesting thing about
wait a minute. They didn't even make it to the podium.
Good point. Debt as a percentage of value, 14% for the Raiders, 28% for the Rams. Most of these have very small amounts of debt. That's kind of interesting because you think if the owners needed money, they just go, that thing's worth $10 billion. I owe nothing for it. Let me borrow some against it.
No, the Raiders just called Tom Brady.
That's true. He's wealthy.
Brady,
right after the Raiders, the team they have to face on Sunday, the New England Patriots, at $9.25 billion. I should have made a bet with the boss on that one too. Do you think? Nah, because either way it turns out poorly. I'd be mad or he'd be mad.
You don't want to do that. You don't want to make. You do not want to make bets with the boss. It's just best that you don't.
He won't pay you and just say, "Do you want to get paid otherwise?" The Jets follow that. The Bears, the Niners, the Dolphins. What's your team again? I'm trying to find them.
They're in the middle. I know. They're in the middle.
Oh, they're way down, number 16.
That is dead center.
By
the way, that is dead center. Yeah. Denver is not a huge market.
No, it's not. Although
it's not as small as Jacksonville.
Sold out the stadium since 1793, I guess, right?
Yeah, and the stadiums, again, even though it's their second stadium, it's starting to show its age a little. So
Mile High Stadium?
It's not as new as
That's
yours.
Not the same as where the Rockies play, right?
No, the Rockies play Coors Field, downtown Denver.
That's right. Yeah,
right down.
I've been there. I ran the bases once.
Down in Lodo. Lower
not
downtown.
Game,
Lodo.
Yeah. I ran it at home. It was fun. The bottom
at 5,280 feet, too. That's pretty good.
Yeah. Yeah. Well, no one was chasing me. Can you guess the last two, the bottom two?
Bottom
least
two.
Valued teams.
Let me think.
Neither of them hits the billion mark, by the way. Kind of surprising to me. Not even worth $1 billion.
I'm thinking maybe Ohio, Pennsylvania-ish. No. Maybe let's go for the Titans. I don't know. I truly don't know the answer.
The Titans, I don't see them.
They're in Nashville.
No, they're 22.
Okay.
Yeah. No, the Buffalo Bills at $589 million, and the Arizona Cardinals at $580 million are the least.
The Arizona Cardinals make sense because, as we remember from doing a lot of business in Arizona for a while, we would go down. Nobody in Arizona attends sporting events. They just,
we went to a hockey game
and nobody was there.
Like 4 people. It was weird.
Nobody was there.
NHL hockey game.
The Diamondbacks not huge.
Yeah. Well, no one wants to go out in the middle of summer.
It's hot. But it's either hot.
It's a dry heat though.
Or everybody's so old they can't get to the stadium in Glendale. It's
God's sakes, come on. I'm gonna let you say that.
Okay. Are you done with that topic now? Can we go to the phones?
All right. I'm gonna hang on to that though. The Raiders are number 4 for a long time.
That's all you got. We're number 4. 855-935-TALK is that phone number to dial, and somebody dialed it from Florida, another place where old people prevail. Justin, welcome to Talking Real Money.
Well, good afternoon, gentlemen.
Hey,
Thanks
Justin.
for taking my call.
My pleasure. Our pleasure.
Yeah, I just had a question about the thrift savings plan and the two bond funds they have in there, the F fund and the G fund. And then what do you guys think about that? And like you're should you split the difference, or do you favor one over the other? I know the F fund's kind of similar to B&D maybe, and the G fund's kind of special.
Yeah, I'm gonna look them up because I always forget. But the F fund, I believe, it tracks the aggregate bond index.
Yeah.
So it's going to have a mix of government bonds. It's going to have a little bit of corporate in there. Might even have some mortgage-backed securities. So you're right. It is more like a BND type of bond. The G fund is only government debt. It's only issued for the G fund, if I remember right. But I always forget what the maturity is on that.
It's intermediate, if I remember correctly.
So I would probably go 2/3, 1/3. I'd probably go 2/3 in the F and 1/3 in the G.
The F is likely to yield more because of the corporate bonds in the portfolio than the G fund. So as a matter of fact, I
think the G fund can never lose money, if I remember correctly.
The G and the F fund can.
Yeah, I believe it can.
It can. So that's why you get the extra return. The return difference historically has been right around 0.5% difference.
Yeah, that sounds about right. What percentage of your portfolio is in bonds?
Right now, about 10%, but over maybe we're going to probably add 5% every.
Yeah, but if I was at 15, I would just.
50,
yeah. If I was just having 15% of fixed income, I'd probably just use.
I was going to
say the F fund.
No, I just use G because then you're getting the lowest degree of volatility for the overall portfolio.
Because, that'll balance.
That's the reason. It's just a better ballast than F. It's not about returns at this point. Not at a 10% portfolio allocation. It's not about returns. It's about ballast. It's about balance.
Yeah. It will be better at balancing.
It'll be better at balancing. That's why I'd go G.
Good point. Yeah,
we disagree.
By the way, we're going to have to congratulate the TSP again for adding developing markets to their international fund at the end of last year. Yeah, they did. Well, we talked about it on a recent show.
We talked about the I fund. Yeah.
Yeah. Mm-hmm.
I thought for some reason I thought you were saying emerging markets. That's what I heard, but they don't have those.
No, they do. They now have emerging markets
in the I fund. Okay.
They didn't have them before.
Because you said developing.
I said
developing.
Yeah, developing like emerging markets. Yes. Yeah. Want another 4 hour
I think I need a nap. I need a nap. No, I don't take that poison. That evil poison you take.
You do drink coffee, however.
I do. I drink it in the morning, and then I give it up. This
is coffee.
Coffee
this is caffeine
with vegetables.
with vegetables in it or something, which is apparently. So Justin, I hope that helps. Yes, I like Don's advice. I would just take the 15%, put it all in the G fund, and then build the rest to balance between U.S. large, U.S. small, and international.
So is that spiked V8 juice or something? Is that what that really is?
Just it tastes good, and I feel great for about 15 minutes afterwards. That's all you need to know.
That's all he gets. Yeah, he runs around the soccer field, and then he drops. 855-935-8255 is our phone number, 855-935-TALK. We'd love to talk with you here on the program, but for us to do that, you have to call.
Tom and Don are talking real money.
Northwest News Radio traffic, sponsored by Northwest Crawl Space Services.
Crash free on a Saturday. It's construction that has you slow with 1 and 2 lanes blocked northbound 405 between Southeast 8th and Northeast 4th Street. In place until early Monday. Heavy and slow from before Coal Creek Parkway. You can get on at 4th and go north. Bellevue to Renton south on 405, less than 20. On the Valley Freeway southbound, you're slower between Auburn into Puyallup with attendees to the Washington State Fair. In the South Sound, I-5 northbound Tacoma to Seattle, you are looking at just under 35 minutes, and you're crash free. Northbound is slower from before the West Seattle Bridge in pockets to 520, and northbound Seattle to Everett on I-5, you are looking at a 25-minute travel time. And traffic is moving freely in the Northwest News Radio Traffic Center. I'm Karen Trombley.
For your real life and real future, Tom and Don are talking real money.
This is one of the few places where you're going to get straight answers to your financial questions, so you need to tell us what your questions are, either by calling us on Saturday at 855-935-TALK or going to talkingrealmoney.com and sending in your questions one way or the other. One of those ways is just the old-fashioned typing them on a keyboard
Yeah, it still works. Apparently, stuff gets through and becomes paper questions, which I answer with Don. Barbara writes us from Aurora, Colorado. I put all my retirement savings in insurance annuities in 3 phases. The first 10 years is stocks, next is an annuity, and the next 10 years another annuity. Not sure my fees will I outgrow this.
I don't understand it.
Let's see. So,
okay, because wait a minute. Is she saying she puts money into an annuity?
But then she falls back and says
stocks.
First 10 years of money is stocks.
Well, that may be a variable annuity.
Yeah, it's hard to know.
See, I don't know the specifics, so that's not a good question.
And I don't know that 2/3 of your money in annuities is a good idea either.
No, I'm pretty confident it's not. But
well, you get mad at me for being too hard on people.
No. You're being gentle. It's very nice.
Okay.
Yeah, because you know the topic for the next hour, so you're trying to soften your
gold bricking.
You're trying to soften your appearance.
Yeah. No, this is okay, but this honestly, this is the kind of question that we could answer better talking to you than we could.
We would have to
this way.
This is one.
We have to know more.
And you're right. This is the perfect example of a question that should be approached this way. You go to talkingrealmoney.com, and then you look for a button there that says Meet an Advisor. Okay? Yeah. You click on that button right there. Just click on that. It'll bring up a calendar form where you can just set up an appointment with an Appella advisor. Now, you're maybe thinking to yourself, no.
You're not selling me anything.
No, I am not going to one of those free dang consultations like those steak dinner people.
Yeah, exactly.
You're not going to be getting one of those because we've been doing this now for 16 years?
16 years. No steak, no fake, as I call it.
No steak, no fake. You're going to actually just get an opportunity to show a real fiduciary advisor who doesn't sell stuff and get a commission what your portfolio looks like, and they're going to give you a real honest opinion on it and give you a couple of ideas as to what you might want to do in the future. They're not going to say, oh, and by the way, you must become a client because you're dead in the water without doing it. If you say, can you guys help me? I don't want to do it. Yes, we'll help you, but we're not going to ask you to do that. We're not going to pressure you to do anything, and we're not going to charge you anything, and we're not going to make it uncomfortable for you. We promise.
By the way, if that has happened,
it hasn't.
Call us and let us know. Well, no one's ever called. I tell them all the time.
Well, we've said to call over 16 years, and no one has ever called.
In 16 years, a long time.
Why have they never called?
Apparently, we don't do that.
Exactly.
Or the number doesn't work.
Maybe it's just a bad phone number.
Exactly. 855-935.
They could
bulk.
They could go to the website, send us a little note.
Yes. No one's ever done that.
No one's ever done that.
Anyway, no. So this is Barbara. This is a good question, to which I do not have. But
we don't have enough to go on.
You really need when you're in this situation. You need to talk to somebody. A real advisor.
Somebody, that's the problem. The person you've talked to in the past apparently sells annuities.
Yeah.
I can absolutely, without fear, say that they are not always required to act as a fiduciary, or they wouldn't be selling this stuff.
110%.
They really wouldn't be selling this stuff. People who act as fiduciaries who always are required to act as fiduciaries, do not sell and accept a commission from annuities. Now, some of them may suggest you go into an annuity, but they will try and find you a no-commissioned annuity into which you should go. They're not going to sell it. If they do sell them and they get a commission, then they're not really 100% fiduciaries. So, that's the way that works. So if you have some questions for us, go to talkingrealmoney.com. Just look for that little contact us form and then type in your question or speak it in.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast is not not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.